In this week's video, we'll cover numerous forms of evidence that tell us it's make or break time for the stock market bulls. There's a reason we opened last week's video with this slide here, emphasizing that patterns are setups, and this type of look here was one of many possibilities. It's another chart that we covered last week. It's dated July 10th, 2019, so a week ago, we were up in this area here. And we said last week it wouldn't be shocking if the S&P 500 revisited 2950 or 2925-ish. If we fast forward to Friday, August 2nd, 2019, we did indeed visit these areas here. The intraday low on Friday was 2914. Thus, it might be easy to classify what happened this week as a 100% normal and to be expected pullback, and that may turn out to be the case. Let's talk a little bit about why that may not turn out to be the case. I guess it's not particularly surprising that the problems this week began with Jerome Powell. After the Fed published a statement that pretty much gave the market everything it was looking for, Powell's press conference was a different story. During the Q&A portion of the press conference, Powell said that this was basically a mid-cycle adjustment, basically sending a message to the market saying, don't expect 4, 5, or 6 cuts here. You may only get 1 or 2. This is a 60-minute chart of the S&P 500 here. This is where that statement came out. As soon as those sound waves started to leave his mouth, the market started to tank. Our concerns this week really don't have a lot to do with price coming back down into this area here. Our concerns are more related to how it got there and how it unfolded. If you weren't watching the markets closely on Wednesday, July 31st, let me set the stage for you. The market handled the Fed's press release or statement no problem at all. Barely moved around, not much went on the 60-minute chart. And then even the opening statement for the press conference went just fine. And the first few minutes of the Q&A went just fine. Until mid-cycle adjustment was uttered. And this is where the concerns start. Concern number 1, the magnitude of this drop. Concern number 2, SPY on average trades about 68 million shares a day. Unbelievably, Powell utters this little remark here sometime after 2:30 p.m., most likely between 2:30 and 3. There's maybe 90 minutes left, an hour left of trading when this little nugget comes out. Institutions ran for the exits at breakneck speed. Even though it occurred so late in the day, trading volume was still well above normal levels, 53% above average levels. Not a good sign. It's a sign of distribution. And maybe more importantly, once again, this is the third time now the stock market is telling Powell and the Fed that they're off base. Last October, Powell uttered, we're nowhere near neutral. Stock market participants sent a strong signal telling him, yes, you are near neutral. Relative to that October comment, Powell was incorrect and the market, not surprisingly, was correct. Fast forward to December of 2018. The Fed raises rates after being given the message in October, a message it did not receive. And then Powell says that the balance sheet runoff program, something the market was concerned about, was basically on autopilot. Once again, the market tanked, telling Powell and the Fed that once again, you are incorrect. The other thing Powell said, I don't see us changing that relative to the balance sheet being on autopilot. Once again, the Fed and Powell were wrong, and once again, the market was right. Within a few weeks, Powell retracted that statement and totally flip-flopped. Moral of the short story, the market is sending Powell a message here, possibly saying once again, this may not be a mid-cycle adjustment, and the economy might be in worse shape than the Fed or Powell understands at this point. Nobody knows where the economy is headed. We do know, this is a fact right here, how market participants reacted to this statement here. This statement and this reaction, this type of volume, all of it tells us to keep an open mind about worse than expected market outcomes going forward and worse than expected economic outcomes. Doesn't mean we're bearish. It just means things are different relative to where they were right here before mid-cycle adjustment was tossed out during the press conference. The S&P 500 was 11 points below the recent all-time high, and after it, it got a message that it did not agree with in any shape, form, or fashion. The S&P 500 plunged intraday 57 points. Somewhat of a similar concern with the president's tweets August 1st. Basically says if we don't make progress with China between now and September 1st, we'll be slapping 10% tariffs on some new goods. Once again, the market did not like it at all. When these tweets came out, we were 16 points below the all-time high. The market tanked from here to here on the 60-minute chart, 64 points in the afternoon. The market said to the Fed, you may be underestimating where the economy is. The next day, the market said to the president, you may be underestimating what the economy can withstand at this point. Volume on August 1st, again, this tweet comes in the afternoon, sometime between 1 and 2 p.m. Eastern Time. Look at volume. 68 million shares on average. SPY traded 142 million shares. That's more than 2 times a normal day. July 29th, 38 million. These concepts come straight out of the Bird Strike Manual, and they don't tell us anything about what's going to happen. They can't predict the future by looking at this hard data here, but we can assess probabilities. And the facts are, the probabilities were much more favorable here than they were here. Probabilities were much more favorable here than they were here. That is obviously subject to change, but we need to see something concrete to offset these concerning reactions here and to offset the message that this move and this move sends about the risk-reward relative to both the market and the economy. As captured in this tweet here, it's very, very easy to adopt by default a deer in the headlights approach here or here. Given everything we knew here, the model and the Bird Strike module called for taking some profits off the table. Doesn't mean we're bearish. It just means we were, for the most part, cash, some bonds, and stocks. We're just a little bit more diversified now, reflecting a shifting risk-reward profile. And our allocation still includes a relatively heavy weight to stocks because not much has changed from a longer-term perspective. You can see relative to what we've been covering with the yield curve in the past few weeks, this is an incremental little push here. This looks worse than this, and this. How can that be? Well, we could draw a trend line here. We broke below the trend line. That's the bad news. The good news is we could hold in this area here what once was resistance, may now act as support, and we held here. Our longer term and shorter term concerns would increase if the 10-2 portion of the yield curve inverts. It has not inverted yet. Continue to take it day by day, keeping in mind that the yield curve has gotten a tremendous amount of exposure. And it's possible if the 10-2 yield curve inverts, possible we could get another waterfall type decline intraday. Obviously, that is to be determined. And obviously, the 10-2 yield curve has not inverted yet. We'll learn something either way. Some other things that are concerning. When you study historical charts, there's a lot of information in failed breakouts. It is possible we have a failed breakout here, or it is possible that we're retesting the breakout and it will turn out to be a successful retest. That too is to be determined. But as you can see on this chart, from these basic levels inside of this box where my cursor's moving around, so this level, this area here, this area here. When the market failed here, here, and here, this is a failed breakout, this is a failed breakout. In the short run, bad things happened, simply helping us illustrate the concept of information that's communicated by markets when breakouts fail. Can't emphasize enough, we don't know if this is a failed breakout yet. It's possible we could hold somewhere in this area here and then move in this direction, and then it becomes a successful breakout with a successful retest. If you're a stock market bull, best case scenario would be for the weekly S&P 500 chart to hold above the center line here, which during Friday's session was at 2906. Obviously, this number changes a little bit day to day. History also tells us it's possible, well within the realm of reason, that we come back down and tag the lower Bollinger Band on the weekly chart, even under a longer-term bullish scenario. It's also possible that we get a look more like this. That would basically say you better be prepared for something like this. This is more concerning here at the early stages of a move. It's telling you the market's extended in a strong manner and it may continue to be extended. Down here, this is more of a pay attention to buy signal. Why? It's later in the move. Earlier in the move, it can be bearish or it can turn out to be bullish if you bounce back quickly. So in the present day, we would prefer to see the S&P 500 hold above the center line, or on a weekly basis, leave some white space in here and then rally. We'll learn something either way. Concerns would increase if this look here, this portion of the Bollinger Band, starts to morph into something more like this and this. It's not what we have now. I said a few weeks ago that when you break out, it's a good time to consider investing capital. Why? Because you're going to learn something either way relatively quickly. If the breakout holds and you get a strong move in this direction with conviction, this can be an extremely favorable risk-reward proposition here. So let's say we had a new account, we're feathering in at a relatively slow rate like we normally do with cash, and then this happens. What do? You stop feathering in. The market is sending you a message saying, slow down. So if new capital came in today in a new account as 100% in cash, we'd be in no hurry to do anything until we find out what happens in this general area here or this general area here. We'd be taking incremental steps at a very, very slow rate and leaving a lot of cash around with a look like this. Keep in mind, this is potentially a failed breakout on the weekly chart. This turned out to be a failed breakout on the weekly chart. And now we're in a situation where the market's basically been moving sideways for 18 months. And we have a failure here, a failed breakout here. This is really a failed breakout too. And we possibly have a third one. That's not what we want to see here. We need to see this market right itself and turn with some serious conviction and pull away from this 18-month base. It's very, very difficult to find a period in history looking back to 1950 that really looks like this. It's very, very rare to see false breakouts, big plunges, false breakouts, and move sideways for as long as 18 months. Let's look at one anecdotal example from history which illustrates why we are taking this seriously until the market proves something to us. S&P 500 daily, 1955 on the left side of your screen, 1957 on the right. Is this period identical to the present day? Absolutely, positively, no. It is similar in some ways and different in many ways. We are simply using it as an example to illustrate basic concepts. Similar to the present day, price is basically moving in a box for about 18 months here. We get a bullish breakout above this level here, and then we're trying to clear this level here. We have a strong trend off of a V bottom. Strong trend V bottom, similar. This move here, somewhat similar to this move here psychologically. And if we look in the rear view mirror, we just had roughly a 10% drop. We had roughly a 10% drop in late January, early February 2018. Then we went up, made a new high, had a bullish breakout, and it failed miserably. And we fell almost 15%. Last year, we fell just under 20%. So this would be similar to February 2018. This would be similar to Christmas Eve 2018. A V bottom, a strong rally, a little give back here, and what appears to be a bullish breakout above this area of former resistance. Before we ask what happened next, it would be very, very easy to be complacent here and say, look, we just had a 10% correction, and then we had a 15% correction. The odds of us seeing something similar to this or this are very, very low. And that's accurate relative to history. Those odds are low, but they're not zero. The breakout attempt above this area of past resistance failed miserably, sharply. And from point A here to point B here, the market fell over 20%. This is absolutely positively not a forecast. It's an anecdotal example of why we have taken some profits off the table and reallocated a little bit to acknowledge that the facts that we have in front of us have changed a little bit. Prior to this little misstep in the press conference and prior to this tweet here, we're allocated for the base case, which is a bullish breakout, and typically at some point you get a conviction type move away from the base. We've had plenty of chances to get the conviction move away from the base. The Fed just cut interest rates, and instead of moving away from the base, the market sent a message to the Fed potentially again saying, you might want to rethink the mid-cycle adjustment theory, or you are underestimating the damage to the U.S. economy and U.S. consumers from the tariffs, and you are underestimating how bad things are relative to global growth. All of that is to be determined. But we know with 100% certainty, things have changed. And after Powell said mid-cycle adjustment, it was time for us to make some incremental adjustments. Just changed our allocation to stocks, bonds, and cash, increasing the more defensive assets, and we did add a little bit of exposure to physical gold. There is a reason we use the expression maximum flexibility. Maximum flexibility means you have to be ready strategically, tactically, and mentally for something like this or this. How's it going to play out? We don't know. We do know this. The probability of bad things happening is higher today than it was here, and our allocations reflect that. The probability of bad things happening is not 100%, and the probability of good things happening is lower than it was here. Doesn't mean the probability of good things happening has gone to zero. Not even close. There's still a lot of hard data from a longer-term perspective that tells us to keep an open mind about a bullish breakout and good things happening for a long period of time. We need to see a recapture of these highs, and eventually over here, somewhere we need to see a conviction move away from this base. We didn't get it here, we didn't get it here, and we don't have it here. It seems odd to acknowledge that your risk reward is very favorable here and potentially very unfavorable here. But that's just the way the world works. And if you study historical charts, as we've done for months and months and months now, going back to 1950, you will find countless examples of failed breakouts giving good information and failed breakouts being followed by somewhat shocking declines. Is it possible this is just a retest and we're going to hold in here? Absolutely, positively, yes. That's to be determined. Maximum flexibility, open to all outcomes, and acknowledging all the data, not just the data that makes us feel good. Doesn't really make much sense to talk about the long term until the market decides what it wants to do here. This is August 2nd at 3:10 p.m. S&P 500 daily. This still looks constructive. Upward sloping bias, still have the characteristics psychologically of an inverse head and shoulders pattern, and we still very well may hold these levels here. This could be a retest, and we might move sharply in this direction. If you're a bull, that's what you want to have happen. But if we dig a little deeper, there are some other concerns. This is the beginning of 2018 here. This is the beginning of 2018, but this time we're looking at the ratio of stocks to physical gold, or GLD, in the ETF world. We just said we wanted to see conviction moves. This is what a conviction move looks like. This is a bullish breakout and a strong conviction move here in 2018 in favor of common stocks and against, on a relative basis, physical gold. When the S&P 500 is coming up off of this low here, it's not particularly surprising that the SPY gold ratio is somewhat lagging the stock market. Why? Because defensive participants, some of them, tend to be late throw in the towel people, and they stay with the defensive assets and bullish outcomes too long. So this lower high relative to this high, when we have higher highs in the stock market, not particularly surprising. This is really not fitting the script of a retest and a push higher. And those previous statements simply speak to probabilities, meaning a look like this is reducing the bullish probabilities, not reducing them to zero, and increasing the bearish probabilities. It's been quite a while, October of last year, since SPY made a new high relative to gold. Again, that's really not the concern. It's this really tepid look here and a new multi-month low here late in the session on Friday, August 2nd. Taken in isolation, it's really not that concerning here because it's possible in some situations that gold could do very, very well when the stock market goes up. But the next ratio that we look at has a similar and concerning look relative to this. This is early 2018 here in SPY. This is early 2018 in the SPY TLT, or long-term treasury bonds ratio. Once again, the failure to break out here, not shocking, but this is not the type of look that we want to see here when we're trying to get a higher conviction push above this base. This is the type of move that we want to see in these ratios. We don't want to see this, where we have a discernible lower high and a lower low, coupled with this very, very tepid look here. Could this reverse? Sure, it could reverse. It just hasn't reversed yet. Similar situation here. We make a low in December of last year, a discernible lower high. Not all that shocking, but now we have another lower high. Again, not that shocking. This is not what we're looking for, especially when the Fed just lowered interest rates, and especially when Friday non-farm payrolls didn't look anything like red flags for a recession. We really like to see, from a probability perspective, if you're a bull, and by the way, we own TLT, so we're not rooting against TLT. We've owned TLT during this whole move in here. But this is why, if you're a stock market bull, you'd really like this to flip. Hence, why we're reducing some exposure, taking some profits off the table on the stock side, and adding to the defensive side. Why? If we go into a 2 to 3 year bear market, we want to incrementally adjust our portfolio. If this breakout holds here and we're trending in a strong trend, we really don't want to focus on diversification. We want to be in the best assets. But if we get failed breakouts and we're in a base and things become more uncertain, then we need to start to diversify to prepare for worse than expected outcomes. Just a couple of examples of things that we can be looking for areas where the market might try to make a stand. Weekly S&P 500 RSI, resistance, S&P 500, peaks, bullish breakout, come back down. What once acted as resistance may now act as support, S&P 500 holds here, and the S&P 500 holds here. If you study historical charts, it would not be shocking to see this RSI come back and kiss this line again, even if we move higher in the long run. If we move down here, it's also possible that the S&P 500 could revisit the lower Bollinger Band, which right now stands at 2768. Takes us a while to get down here under that scenario. This is a rising line, so most likely this level would creep up. It really just depends on how fast under that scenario you get there. Right now it's at 2768. It's a long way from 2933. Is there any good news on this chart? Yes. This is a bullish breakout. Support, it held. It's possible that we're going to get support down here. You can see here rate of change for the S&P 500. When good things are happening, our rate of change for the most part is above the zero line. When bad things start to happen, we go below the zero line, below it. For now, we're hanging in there, telling us it's possible that all we're doing here is visiting the center line on the weekly chart, which we kissed for the most part this week. The low was 29.14, as we mentioned earlier. The center line is at 29.06. Just simply some guideposts. Are we assuming that this will hold? We are not. Are we assuming that we will get here? We are not. Are we assuming if we get here that we'll bounce? We are not. But we'll learn something either way, and it helps us potentially prepare for a reversal. We've talked a lot about similarities between the present day and 2016. 2016 S&P 500 monthly, Bollinger Bands, you get the bullish breakout, a retest here. We could be doing something similar here. You'll notice the retest comes when the upper Bollinger Band is kind of moving sideways. In this case, you hit it and you go backwards. Don't hit it. We did hit it, now we're going backwards. So you can make an argument that we're here. We're still above a rising center line, But one thing that is a little bit concerning here, number one, this is an extended move that's bullish. It's early in a move. This is conviction, this is buying power. This look here, from a probability perspective, is interpreted differently than this extended look here. Why? This is early, potentially, in a new trend. This is late in a new trend, or a trend that began up here. Early, and eventually you push higher. Early, you push higher. Here, when we're breaking out, notice monthly RSI, resistance. Here's a bullish breakout here that pretty much coincides with the push to new highs. In the present day, if really good things are going to happen, we pretty much know that we need to get something like this. We already had it here. We don't have that in the present day. We have not cleared this. This looks weaker relative to this, and until it changes, we will respect that. Monthly center line, which will also move. 2786 is a good reference point for us. The lower line is all the way down at 2545. Notice in 2016, here we visited it, but not here. Is there anything else from a probability or conviction perspective that tells us we should respect worse than expected outcomes if we do indeed get a failed breakout in the S&P 500 index. The answer is yes. Remember, we said we wanted conviction moves in the present day like this. This is conviction. This is a breakout. This is easy here. There's no doubt you're in the right place. Not the case here yet. Would this be somewhat of a falling wedge look? Yeah, it's possible, but we just made a new low here in favor of gold and against stocks. We need to see this morph into something like this, which may happen. It just hasn't happened yet. Keeping in mind, this is the conviction that we want. This is the tepid look that we want to avoid. This is the conviction look that we want. A diversified basket of bonds. Basically, think of this as somewhat of the total bond market type ETF relative to intermediate-term treasury bonds backed by the full faith and credit of the U.S. government. There is default risk in this basket. There's really no default risk in this basket, at least theoretically. This is a conviction move here in economically sensitive bonds. This basket has economically sensitive bonds relative to conservative bonds. This is 2016. Instead of getting a look like this, we almost, this week, just got the opposite. You've been working in the markets and working with charts for years and years and years. You've probably noticed the original angle off a low sometimes becomes relevant literally years later. What once acted as support, may now act as support. That's not a good look there. That's not really what you're looking for. Extend a trend line here from this low to this low here. You can make an argument. This is a trend line break here. This is step one for a trend change in the ratio. Step two, we get a discernible lower high relative to this high. And step three is here, a discernible low. So the odds are shifting a little bit here, but we know it's possible that this might act as support. Well, it did for a little while, but that doesn't look so good now, simply speaking to probabilities. We would like this chart to morph into something more like this. Not what we have. We have to trade the facts in front of us, which say 2019, from this perspective, looks worse than 2016. We'd like to see MACD turn up as it did here. We'd like to see MACD turn up. That's not what we have. MACD's turning down on August 2nd. Why do we still have stocks? Because there's a ton of data out there that tells us to keep an open mind about better than expected outcomes. A ton of it. And there's numerous items on this chart here that tell us it's quite possible somewhere in this band here between roughly 2750 2975 that the S&P 500 will try to make a stand. But you can also make an argument. If we don't make a stand here, the right side of this chart is starting to look discernibly different from the left side. If we move in this direction, bearish probabilities will start to increase, just as they increased this week when we had a failed breakout. The bulls aren't dead yet, and that's reflected in our allocation. But the data that we have in hand today looks worse than it did a week ago, and that too is reflected in our allocation. Going forward, we have no bias as to what we want to have happen. What we want to have happen is to get allocated properly. If that means leaving it alone, we'll leave it alone. If it means migrating more to the defensive side of the ledger, we will migrate further in that direction. If it means holding what we have on the growth side of the ledger and eventually adding back to it, we'd be thrilled to do that in this area here. And we'd be thrilled to do it quickly if we see what we want to see. That may happen, but it hasn't happened yet, which means it's incredibly important that we head into next week and every week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shravaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.